So far in our discussion regarding the accounting cycle, we've focused on the first three steps. Those steps are for us to analyze, record, and summarize the transactions. In this video, we're going to focus on the last two steps, which are to prepare a trial balance and to report the financial statements. As each step builds upon the previous one, let's first revisit the first three steps and then build by going to the fourth and fifth step. Remember, if we were to analyze a transaction, we would look at its impacts on the accounting equation, assets equal liabilities plus stockholders' equity. For instance, we might have cash go up and related liability like notes payable go up as well. The second step would have us actually record that transaction in an accounting format. So for instance, in that scenario, we might debit cash, and that would increase the asset, and credit notes payable, and that would increase the liability. We then might label this as transaction A or use a date if we had it, and then move on to step 3, which is where we summarize the activity of individual accounts. So for instance, if we were summarizing the cash account, we would draw a T account here. Remember, we have a debit side and a credit side, and for assets, the debit side is going to increase it and credit is going to decrease it. And then we would do what we call post the transaction. So the journal entry here will get posted down here, and we would debit cash for whatever the amount is, this X amount here. The purpose being that the T account or the summarization of the account allows us to determine the balance or the amount in each individual account, whereas the recording of the transaction allows us to tell the details. So here we have the detail of the individual business events that are considered to be transactions, and over here we have the summary or the balance of the individual accounts. And we did an example of just cash, but we would do them for all of the accounts that have been affected by the detail, by the journal entries during the period under consideration. This then allows us to move on to step number 4. Once we have analyzed, recorded, and summarized all of the transactions, we then make a report, which is sort of like an interim step to creating our ultimate goal, which is the financial statements. This interim report is referred to as the trial balance. The trial balance will have 3 columns: the account name, a debit column, and a credit column. The goal of the trial balance is twofold. One, it helps us prepare the financial statements by putting the accounts in correct order. And I'll show you what I mean by that here in just a second. But the second thing it does, and maybe more importantly, is that it ensures all debits equal all credits. Remember, the double entry system, the debits and credits that we utilize to record journal entries in step number 2 serve as an additional check or balance to ensure that the entire story, the entire record is captured. If the total credits and total debits don't equal each other, then we know we've missed something, and that's what this trial balance serves to catch. So the idea is that if total debits and credits don't equal, there's something that's been recorded incorrectly in some way, shape, or form, and we need to go back and discover it before we prepare reports that ultimately individual users rely on. Remember, these reports are prepared for external users, and so they'll be making decisions off of them, which means we need to ensure that they're accurate, and that's what this report, this interim report, the trial balance, serves to do. Here we have an example of a trial balance. Notice we have the header right here. It's at a specified date. Notice we then have 3 columns. We have the account, title, we have debit, and we have credit. And notice that the debits and credit totals match. As it relates to goal number 1 of the trial balance, notice the order in which the accounts are listed on the trial balance. First, we start with cash, and we have supplies, equipment, software, logo, trademarks. Right here, this represents total assets, right? All of those are labeled or defined as an asset. Here we have accounts payable, notes payable. These would be liabilities. And below that, we have common stock, and eventually as we progress in the semester, we'll have retained earnings as well, and this represents stockholders' equity. Now, this should look familiar to you. These are the components of the accounting equation, but it's also the components of the balance sheet. And remember what our 5th step is. Our 5th goal is for us to create the financial statements. And so the idea is that this interim report, this trial balance, has already organized the accounts into the format of the balance sheet. And now this becomes pretty straightforward because we're taking these same accounts right here and we're putting them in the order or the format of the financial statement, the balance sheet. And as we progress into chapter 3, we'll also include revenues and expenses, and we'll order those in the order of the income statement and sort of progress from there. Keep in mind how all of the accounting cycle steps are connecting together. So our first step, which is analyze right here, we say assets go up, and notice how that connects then to the recording step right here where we debit that asset to make it go up. Then notice how this piece right here then gets posted down to the summary account over here. And then notice this last piece here, that this amount, the balance, whatever that is in the total, that becomes the amount that then gets posted to the trial balance. So this becomes our amount for cash. In other words, these accounts that we have listed over here in the trial balance get populated from the T account amounts that we've summarized in step number 3. And then finally, we take these accounts and we place them onto the financial statements in step number 5. The final step in the accounting cycle is for us to prepare our financial statements. And the one we're going to look at in chapter 2 is the balance sheet. You've already had exposure to preparing the balance sheet. You're familiar with the components of the header, like the name of the company, the name of the financial statement, the date, and putting at or as of in front of the date. You're also familiar with the general sort of format where we have the assets, we have liabilities, and we have stockholders' equity. You also know that the total assets need to agree to the total liabilities and stockholders' equity here. But the piece that we introduce that's new in chapter 2 is this idea of not just a standard balance sheet, but a classified balance sheet. And the thing that's unique about a classified balance sheet is that it splits assets and liabilities into current and non-current. So this being the non-current piece or non-current assets, and this being the non-current liabilities. It's not uncommon for a balance sheet to have a subtotal for current here, or a classification for current and a classification for current here with liabilities, and not classify non-current either assets or non-current liabilities, because if you're in the total category of assets and you're not current, then by default you must be non-current. Same way with liabilities. If you're in the total category for liabilities and you're not current, then by default you must be non-current. The purpose of grouping assets and liabilities as current or non-current is to provide additional information to the financial user, which is the purpose of anything that we do in financial accounting, is to provide added benefit or usage for the external user. If we were to give an asset the classification of current asset, what we're indicating is that this asset will be used up or turned into cash within 12 months or less, or a company's operating cycle, whichever is longer. Notice what we're then telling individuals, again, in the most concise way possible, about the financial information about this Noodle Cakes company. We're indicating that they have some assets that are going to be used up or turned into cash within the current year, within that 1 year time frame, and some that are going to be used for a longer period of time. That's the non-current assets. This helps us understand the timing of how these resources will be used or turned into cash. And the same is true on the liability side. For the definition of current liabilities, we can say that these are the liabilities that will come due or mature within 12 months or less, or an operating cycle, whichever is longer. Notice what this simple adjustment of providing current and non-current provides the financial statement user. And here's sort of the interesting part where you can start to analyze a company based upon the accounting information now that we've built it from the ground up. Notice we have information on both current assets and current liabilities. What this is indicating is that we have assets that are going to be usable within the current year, and we have current liabilities that are going to come due within the current year. This will help a user determine, do you have enough assets that are usable to cover the liabilities that we know are going to come due? Understand why that's a different analysis than asking the question, do you have enough assets to cover total liabilities? For instance, if all of your liabilities are coming due within the year and you have a very small amount of cash and not much ability to acquire additional lines of credit, then that would imply that there may be a concern or a risk with the company on whether or not they could cover these liabilities that are coming due. But if the liabilities are coming due in a much later period of time, then you may not be as concerned of whether or not the company has enough cash on hand to cover them at this point. So by splitting the information into current and non-current, we are providing more information to the financial user to make a better analysis. We can take this one step further by doing a ratio analysis using components of the classified balance sheet. The ratio that we're going to examine is the current ratio. It is calculated by taking current assets and dividing by current liabilities. While it's possible for an individual to simply look at total current assets and total current liabilities, the current ratio allows for one to compare from one company to another company. Because remember, not every company is going to have 21,300 in current assets and 10,200 in current liabilities. So making these numbers comparable is easier by placing them in a ratio analysis. And understand that we do that all the time, right? You might go shop for cars and compare miles per gallon. That's a ratio. The other day, I was trying to choose an orange juice brand at the store, and I was looking at price per ounces. The idea is by looking at the numbers in ratio format, we're able to compare one thing to another, even though the individual numbers themselves are different. Notice that the current ratio asks the question, do we have enough assets that are usable within the year to cover the liabilities that are going to come due within the year? And so from this, we can come up with a general rule of thumb to say, all things equal, we would like the ratio to be 1 or higher. And that would imply that you have enough current assets to cover your current liabilities. Now, there's a lot that goes into analysis like this. We can't, first of all, look at a single ratio. We have to look at it in context with other ratios. We also have to look at the operating plan of the business and whether or not it typically operates with a less than 1 current ratio. We also have to look at the industry, and we'd also want to compare it to its other competitors within the industry as well to see if it's performing higher or lower, even if it is less than 1. But as a general rule of thumb, we'd say 1 or higher is typically better. And then also have the caveat that if it's too high, that might mean that they're underutilizing their resources, that they haven't invested enough current assets into non-current assets to help grow the business. So there's a lot to take into consideration, and we're just starting out in our analysis. But this ratio does give us the ability to sort of consider the liquidity, the company's ability to cover these liabilities that are coming due with the assets that it has available. It gives us an indication of that, allows us to compare one company to another.